Welcome to this deep dive on HSA hidden risks, especially during transitions from self-only to family HDHP coverage. In this video, you'll learn why your HSA dashboard can be misleading, how contribution limits really work, and how to avoid IRS penalties. We will use timelines, examples, and a quick quiz to reinforce learning. Let's begin with an overview and then move seamlessly into a brief disclaimer. Here's the agenda. First, why HSA account dashboards can mislead you. Second, how monthly contribution proration actually works. Third, how the last month rule and the testing period interact. Fourth, specific steps to correct excess contributions. Fifth, partner eligibility myths versus reality. Finally, a concise action checklist. With that roadmap set, let's move into a quick but important disclaimer. This video is for educational purposes only and is not tax, legal, or financial advice. Your situation may differ based on coverage dates, plan eligibility, and changes to IRS rules. Verify current year limits and definitions with IRS Publication 969, Form 8889, and Form 5329, and consult a qualified professional. Now that expectations are set, let's explore why your HSA balance may not be a reliable guide. Your HSA dashboard may display a remaining contribution limit that appears to allow the full family maximum after you switch to family coverage. However, the IRS bases eligibility on your actual coverage for each month, not on any bank or administrator display. The taxpayer is solely responsible for compliance. If you contribute more than you are eligible for, the excess is subject to income tax and a 6% excise tax for each year that the excess remains in the account. Now that we understand the risk with balances, let's examine how monthly proration determines your true limit. This timeline illustrates a year where you hold self-only coverage from January through September and switch to family coverage in October through December. Each month contributes 1/12 of the applicable annual limit. The total annual limit equals the sum of the monthly portions for months with self-only status plus months with family status. A common pitfall is assuming that after the switch, the remaining months allow the entire family maximum for the year. The timeline clarifies that prior months still restrict the total. Next, we will formalize proration with a simple method you can apply. To compute your true annual maximum, list each month and mark whether your coverage was self-only or family. Then apply monthly proration. The eligible annual maximum equals the months with self-only times 1/12 of the annual self-only limit plus the months with family times 1/12 of the annual family limit. If you are 55 or older, add catch-up contributions according to monthly eligibility. Compare the result to your actual contributions to identify any excess. The example shows a hypothetical year with 9 months of self-only coverage and 3 months of family coverage, using representative limits, yielding a prorated maximum of $5,362.50. Be sure to confirm the actual current year limits with official IRS sources. With proration under control, let's turn to the last month rule, which can change the result, but only under strict conditions. The last month rule allows you to contribute up to the full annual maximum if you are HSA eligible under a qualifying HDHP on December 1st. Importantly, it does not provide retroactive relief if family coverage begins on January 1st of the following year. To benefit for the current year, you must have the higher coverage status before the year ends. Moreover, invoking this rule starts a testing period that requires you to remain HSA eligible for the entire next calendar year. If you lose eligibility during that period, the excess amount above what monthly proration would have allowed is included in income and subject to an additional 10% penalty. To visualize this interaction, let's walk through a sequence of events. This sequence diagram shows the flow when you enroll in family coverage on December 1st. You then contribute up to the full annual family amount. The IRS recognizes the start of the testing period, running through the entire next calendar year. If coverage lapses during that period, the IRS reclassifies the excess as income and applies a 10% penalty. This causal sequence clarifies how timing and continuity of coverage directly affect tax outcomes. Before we solve a scenario, let's confirm the core lessons with a quick question. Question: you had self-only coverage from January through November and switched to family coverage on December 1st. Can you contribute the full family annual limit for that year? Options: A. Yes, and there is no testing period. B. Yes, but only if you remain HSA eligible all of next year, meaning the testing period applies. C. No, you are stuck with prorated self only for the year. D. Only if your HSA dashboard shows the family limit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is yes, but only if you remain HSA eligible all of next year. The last month rule allows the full annual contribution based on December 1st eligibility, but it triggers the testing period. If eligibility is lost during the following year, the difference above the prorated amount becomes taxable and is subject to an additional 10% penalty. Next, let's cover how to fix an overcontribution if you suspect one. To fix an overcontribution, first request a return of the excess amount plus any attributable earnings from your HSA custodian before the tax filing deadline, including extensions. Next, report the correct figures on IRS Form 8889 with your tax return. If any excess remains uncorrected past the deadline, a 6% excise tax applies each year until the excess is removed, and you would use IRS Form 5329 to compute that excise. Finally, adjust future contributions promptly to prevent repeating the error. Now that you can correct mistakes, let's highlight the testing period trap to avoid creating them in the first place. Invoking the last month rule raises the stakes if your eligibility next year is uncertain. A mid-year lapse during the testing period causes the excess above the prorated amount to be included in income, and also triggers a 10% penalty. If your employment plan or eligibility might change, consider avoiding the last month rule and sticking to prorated contributions. To tie these concepts together, let's map the compliance landscape. This mind map positions HSA compliance at the center, branching to coverage types, contribution mechanics, correction steps, and partner considerations. Under coverage, the distinction between self-only and family determines monthly allocation. Under contributions, the monthly proration, the last month rule, and the testing period interrelate and affect your allowed amounts. Under corrections, withdrawing excess with earnings and filing forms 8889 and 5329 are key actions. Finally, under partners, individual eligibility and start dates matter, since contributions are determined per individual coverage status. With the framework clear, let's demystify partner contribution myths. First myth: if one partner has family coverage, both can contribute the family maximum. In reality, eligibility is individual, and each person must be HSA eligible under a qualifying HDHP during that tax year. Second myth: HSA dashboards always reflect IRS rules accurately. In reality, administrators can miscode, and the IRS bases eligibility on actual monthly coverage. Third myth: January 1st family coverage allows you to contribute last year's family limit. In reality, you must have the higher coverage status on December 1st to use the last month rule for the prior year. With these myths addressed, let's test your understanding with a short question. Question: your partner begins HDHP family coverage on January 1st of the current year. Can they contribute last year's family limit? Options: A. Yes, as long as you file jointly. B. No, eligibility starts when they are covered in the current year. C. Yes, if the HSA provider's site shows available room. D. Only if they make a catch-up contribution. You may pause the video now to consider. We will review the answer next. The correct answer is no. Eligibility starts when they are covered in the current year. Filing status does not grant retroactive eligibility. A dashboard display does not override IRS rules. Catch-up contributions are separate and only apply to eligible individuals age 55 or older. Now, let's consolidate your action steps. Your action checklist includes: track monthly coverage status, compute your prorated maximum before contributing, apply the last month rule only if you are confident about maintaining eligibility for the entire following year, verify current limits and definitions using IRS Publication 969 and your plan documents. If an excess occurs, withdraw with earnings and report using Forms 8889 and 5329. And above all, do not rely solely on HSA dashboards. Confirm with your own calculation. Before we wrap up, here's a quick visual summary of the logic flow. This flowchart starts with monthly coverage determination and assigns 1/12 of either the self-only or family limit per month. The annual sum is then considered against the last month rule. If not using the rule, proceed to compare with contributions. If using the rule, the testing period applies next year. If you will remain eligible the full year, continue. Otherwise, the excess is reclassified as income with a 10% penalty. Finally, check for excess. If there is an excess, withdraw it with earnings and file Forms 8889 and 5329. If not, you are compliant. Let's summarize the main points. In summary, the IRS determines HSA eligibility on a monthly basis, so do not blindly trust your account balance display. Prorate your contributions by coverage type, and remember that December 1st eligibility can permit the last month rule. The testing period is strict, and loss of eligibility during the following year triggers income inclusion and a 10% penalty. If you discover an excess, withdraw it with earnings, and report using Forms 8889 and 5329. Finally, eligibility is individual, and partner start dates matter. As a final note, keep documentation and confirm current year numbers with official sources. Now, let's close with a quick thank you and a call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. Share your questions, edge cases, or experiences in the comments so others can learn too. Your engagement helps more people avoid costly HSA mistakes.